Good day, everyone, and welcome back to another episode of A Lawyer and a Policy Analyst Walk into a Bar. This is episode 2 of season 6, and today we are talking up and up. We're talking about prices, inflation, and the Caribbean, and we have with us another great guest, as always, Mr. Keenan Falconer. He's an economist, and of course, we're going to let him introduce himself in a bit. But as always, I'm the lawyer, Jadrick Cummings.
And I'm Delano D'Souza, the policy analyst. And yeah, like Jadrick said, we're talking up and up and up. We're talking prices, we're talking inflation, and we're talking about the impact on the Caribbean. Of course, we have another great guest with us. This is episode 2, and of course, we're always trying to have great guests to break down some very important topics for you. So I'm going to let Keenan introduce himself, and then we're going to go right into the pod.
Right, so greetings everyone. I'm Keenan Falconer and I'm an economist with the Central Bank of Jamaica. I'm also a policy analyst and researcher with the Sir Arthur Lewis Institute of Social and Economic Studies at the UMONA.
All right, great to have you. A very knowledgeable guest here, and we're looking forward to this discussion. So guys, we're going to jump right into it as usual. By way of a little background, a lot is currently being said about globally about rising prices and higher cost of living. I mean, it's nearly impossible to open your social media, to read a newspaper. For those of us who still read physical newspapers, to listen to the radio, to watch TV, without somebody talking about prices going up and up. So nearly every country is complaining as times get harder. People are saying, boy, times hard, everything wrong, things wrong, as we just say in Vinci. So we thought it would be,
Things wrong.
Yeah, man, things wrong, things hard. So we thought it would be a good episode to do inflation. So over the next 45 minutes or so, we're going to talk to you about what is inflation, about how inflation is measured, the impacts of inflation, tools for fighting inflation, among other things. Why is inflation currently big news? So new projections from the World Bank as of June 7th indicate that global growth is expected to slump from 5.7% in 2021 to 2.9% in 2022. Now, of course, you guys would recognize that this year was expected to be, the rebound year. 2022, travel is back out. All of these things are happening, and the economies are reopening. So the anticipation was that we would have stronger growth. Now, of course, this is significantly lower than the 4% that was anticipated in January. So in January, there was a lot of optimism about how 2022 was going to play out from a growth perspective. That has changed somewhat, and the growth projections have been downgraded. So compounding the damage from the COVID-19 pandemic, the Russian invasion of Ukraine has magnified the slowdown in the global economy, which is entering what would become a protracted period of feeble growth and elevated inflation, according to the World Bank's the latest global economic prospects report. So this raises the risk of stagflation, and we're going to get back to stagflation in a while, as well as and it's particularly harmful, Jadrick and Keenan, for mid and lower income economies like ours. Yeah. So as a result of the damage from the pandemic and the war, the level of per capita income in developing countries this year will be nearly 5% below its pre-pandemic trend. Very concerning for us, particularly in the Caribbean. And so, again, that motivates us in terms of why we're discussing this topic today. And the World Bank President David Malpass would have said the war in Ukraine, lockdowns in China, supply chain disruptions, and the risk of stagflation are hampering global growth. And for many countries, recessions will be hard to avoid. So there is a lot of doom and gloom talk going on right now as a consequence of this inflation. Yeah. In the 34-member Organization for Economic Cooperation and Development, the OECD, consumer prices, the CPI, would have risen by 9.2% year on year in April 2022, compared with 8.8% in March 2022. And of course, excluding food and energy, year on year inflation increased by 6.3% in April, compared with 5.9% in March 2022. And food price inflation in the OECD continues strongly, reaching 11.5% in April. So there's a lot of talk here about CPI and so on. We're going to break these things and these terms down in a little while, Jadrick and Keenan. But in the United States, we want to talk a little bit about the United States, because as you guys know, there's a talk that we always say in the Caribbean, when the US sneeze, we just catch a cold in the region. So in the United States specifically, the consumer price index, the CPI, rose by 8.6% in May, from a year ago, with the highest increase since December 1981. So you recognize there why there's so much concern. Yeah, 1981 was the last time we had such high inflation in the US. Core inflation, excluding food and energy, also rose by 6%. And of course, both of these were significantly higher than expected. So, the surge in food prices, gas and energy prices as well have contributed to the gain. And of course, fuel is up by over 106% over last year. So that represents a big chunk of where this inflation is coming from. And again, we'll talk about that in a while. From the Caribbean perspective, Jamaica, Keenan, which is where you're from, as we know, earlier this year, Jamaica would have found that point-to-point inflation in February 2022. They reached an 11-year high of 10.7%, and I believe, and you could correct me if I'm wrong, they sort of increased to 11.3% in March. So that's big. So according to the Statistical Institute, this was influenced mainly by the inflation rate for the divisions of food and non-alcoholic beverages, housing, water, electricity, and other fuels, and transport. In Barbados, which is where I am based, the central bank would have recorded that in 12 months between March 2021 and 2022, there was a 9.3 jump in the cost of living here. And I feel it every day. It's pressure all around. Yeah. So essentially across the Caribbean, we have similar patterns. We have similar worries about inflation, similar trends. And so we're not going to focus on those statistics. What we want to do is instead start to break down inflation and what it means. So, I don't want to go on talking for too long in terms of the stats and the data and so. Go ahead, Jerry.
Yeah. No, just saying, as you're getting to that point, I study a bit of level econ and thing, I'm not the economist here of the two, but of the three of us. But, when you throw around these terms, I know a bit of demand and supply, elasticity, downward spiral, those things. Not to brag, but, just for our listeners now, we want to, I think, get to the crux of it now. What is inflation? Like, when we talk about inflation, what are we talking about? And, how is it measured as well?
Well, inflation is a general increase in the level of prices between two time periods, typically 2 years. And as we said, it's measured by the Consumer Price Index. So what that is that statisticians will go out into the field and they use a basket of goods. Mm-hmm. And that basket, in Jamaica's case, contains 13 different categories. So food, transport, wholesale, retail, energy, and so on. 13 of the goods that we see based on our household consumption patterns that persons will tend to use or consume the most. And when they find the aggregate level of prices, and it should be mentioned that it's not individual prices. So if you go to a shop or a supermarket and there are wide differentials in prices, it's not just measuring individual to individual. It's an aggregate measured in aggregate. They find the level of prices at this point in time, and then they're going to do the same thing again 12 months later. So we have the 12-month point-to-point inflation, whatever it was, say, now we're in June, so June 2021 compared to June 2022. So, and the different time periods of inflation that we'll see, calendar year to date, and I know it can get confusing at times. We see fiscal year to date, but the point-to-point inflation is what we're concerned about. And of course, in Jamaica, we're seeing that it has increased it's reached double digits now. So the prices are 10%, 11% higher today than they were a year ago. And in terms of the types of inflation, as it relates to the causes now, not just the time period, we find that the inflation can be demand pull, where the demand for goods and services.
But Keenan, before you move on there, I just want to zone back in on the CPI, because this is something that a lot of people has been asking about. They see the CPI term being bandied about and so on, and you would have given some explanation there. So I want to ask you some follow-up questions with respect specifically to CPI. And I was talking to somebody the other day, and they mentioned, they said CPL by mistake instead of CPI, and I said, hold on, the cricket we're dealing with now is inflation. And so that's when I realized that the CPI thing, it's not as understood as we may think. So you've spoke about what the CPI is, yeah? And I wanted to ask you, and you just to repeat, if you touched on it before, I know you did a little bit. How was the basket of goods chosen? And is it the same across the region? Because that's important, because persons see inflation going up in Jamaica, they see inflation going up in Barbados at different rates, and then the conversation then becomes, hold on, is the CPI universal? Yeah?
So the baskets are going to differ, I mean, across jurisdictions, but each jurisdiction across the Caribbean should have a similar kind of basket. So we expect to see the same or similar kinds of things. You expect that food and energy at least will be common to each of them. They'll have different subcategories that have different specifications, but the wider idea is that these baskets comprise goods that are specific to the households in the country. So in Jamaica, for example, ours is based on our household consumption survey. What is it that persons use? So you're going to find that maybe in Barbados or in Trinidad, they have a different demand for certain goods that is either higher or lower, and they decide to include that in their basket or they exclude it from their basket. And but the wider idea is that the basket is supposed to be a fair reflection of the consumption patterns of the population so that we can get a more accurate determination of the level of price changes and price increases between two periods.
So basically, if it is that we have a scenario where a particular food, let me say Haroon Bay, I drink a Haroon Bay now. Suppose it's a scenario where Haroon Bay isn't being consumed as much as before. So then perhaps that Haroon Bay they might take a decision to, hey, now we need to exclude Haroon Bay from the CPI because it's no longer a commodity that is being consumed widely in the economy. So that's what you're saying in terms of the selection of the basket and the goods in the basket, because you want it to be reflective of general consumption patterns within a specific
they might exclude it, but they could also, because each category is weighted differently, so they can just either increase the weight or decrease the weight. Let's say it accounted for 6% and now it's probably 3%, or it went up to 7%, that kind of thing. So it's supposed to be dynamic, but it is something, in our case, it is governed by the system of national accounts from the United Nations, just to give it somewhat of a standard. And we are recently in Jamaica updated to the 2008 version coming from 1993. So in the future, they might update in the next couple of years to another kind of basket when the UN determines that this is how we're going to do things now in the future.
Yeah. And I think for us, Johnny, I think we would have already gone to the 2008 standard in St. Vincent. I think many of the other countries have, in terms of the standard there from the. So that's so many questions that I have on CPI. The next question I have on CPI, we would have spoken, even as I spoke to some of the stats and so from the OECD and the US, we would have noted that we would have separated things like fuel and consumption in terms of different elements of the CPI. Now, what I want to ask you, Keenan, is why would we separate fuel and food and so on and try and kind of break down the CPI in the way that we do? And why is that important? Because we want our listeners to understand that as well, to know that even within the CPI, there are different elements and weights and so on that are very important in terms of setting policy and the like.
Absolutely. So, we have the headline figure that we're seeing, which is the 10-11%, which is an overall figure, but that is an average that tends to hide a lot of key details underneath. So we tend to separate inflation in terms of core inflation and non-core inflation. So non-core inflation is what would include food and fuel. So commodity prices, energy prices, and those two in the Caribbean at least would be determined largely by international prices on the world market, whereas everything else that's in the basket would count as core inflation. And it's actually a really interesting discussion because when we look at core inflation, or non-core inflation rather, in terms of food and fuel prices, that we are subject to world forces. To what extent can we really control the price increases in those? So in Jamaica, for example, the central bank employs inflation targeting. Its mandate is price stability, where it's supposed to maintain an inflation rate of 4 to 6%.
4 to 6%. Yeah.
And there have been some concerns to say, can we really do that when a lot of inflation comes externally? And prior to COVID, it did manage to do that, but it was predicated a lot on the effectiveness of communication strategy from the bank that governs inflation expectations and consequently inflation. So I know I mentioned inflation expectations, and that is something that it's almost a self-fulfilling prophecy. If people tend to expect that prices are going to rise in the future, then that feeds into the actual projections for inflation itself, and that can lead to an increase in prices in reality.
Yeah. Yeah, I mean, very important, Keenan. So you would have jumped ahead a little bit in terms of we covered CPI, and I think I don't think people can confuse it with CPL anymore. We ain't talking cricket. I think going forward after they watch this episode here, people are gonna know what we're talking about when we speak about CPI. Yeah. So we spoke about the causes. We want to move on now to talk about the causes of inflation. Now you would have mentioned a few things, and even as I teach my students, and you were talking about expected inflation, that's one of the more difficult topics for our students, for some of my students to grasp, because I teach macro, and what I realized in terms of my students, that whole notion of inflation being a self-fulfilling prophecy, and of course, Keenan, you will know it's inflation, this period plus expected inflation and so on, and the expectations really do feed in terms of what we expect inflation to be, particularly in the context of the price setting mechanism and so on and all of that. And I found it a very difficult concept for some of our students, some of my students at least, to grasp. So before we go down, we break it down. Let's pull back a little and talk about the causes of inflation. You would have started before talking about the cost push, demand pull. Sorry. Of course, in there, we do have to recognize that when persons think about types of inflation, invariably think about imported inflation, which of course falls under one of the categories. So it's important. So can you just walk us through the types of inflation?
So broadly, there are two main types and a third lesser type, a more recent vintage. So demand pull is when the demand for goods and services exceeds the production capacity because of an increase in money supply and credit in the monetary system. So more money in circulation, a higher velocity of money, it's going to lead to an increase in spending power. Then persons have more money in their hand, they want to spend more money in the economy, and it's starting to overheat. And demand then outstrips supply, which results in more money chasing fewer goods. So when you have more money in the economy chasing fewer goods, which are not being produced as often as they should be, then prices are going to equilibrate, and to do that they have to rise so that demand and supply can go back to an equilibrium level. Because in a market economy, the prices are always going to, that investment that guide the economy. And then the next cost push inflation, which is what we're experiencing now because of the disruption in the supply chains worldwide, in terms of, in China, in Egypt, in the canal a couple months ago. So there's an increase in prices due to an increase in production costs. And we see that especially in terms of freight, which has skyrocketed in terms of shipping prices all over the world. So those inputs in the production process then lead to a rise in costs, which are invariably passed on to the consumers in the final product, and which is unfortunate. But we can't really do much about that cost push inflation until supply chains start to normalize and regularize themselves and the production capacity goes back to normal. And then the third type that I wanted to discuss was built-in inflation, which, as I said, is due to inflation expectations. So when people expect that prices go up in the future, they're going to demand higher wages now in the present to maintain their standard of living, because of that expectation. And that in turn is going to influence higher prices as people demand more and spend more. So it leads to a wage price spiral. So as prices go up, then wages go up, prices go up, and wages go up. And that spiral seems almost never ending.
So I wanna zone in on a couple of things there, Jadwick, and Keenan. Well, first and foremost, you have spoken about the demand pull inflation, and you said that's when more money is chasing fewer goods. Now, basically, for those of you listening and watching, that's when everybody, money flowing, things nice, money flowing in the economy, interest rates, and I want to tie that to interest rates, Keenan and Jad, because that's important. As you would know, a lot of persons that we've recognized recently, we've had a lot of historically low interest rates and so on, and that of course has fueled borrowing because interest rate represents the cost of borrowing, and so more persons, more businesses and so on have been borrowing, and of course that has implications in terms of demand, because obviously if persons are borrowing to do constructions, there's more wages and so on, there's more money chasing fewer goods and services, like Keenan would have said. So that's important. So you would have recognized, and I know for example, in Jamaica, Keenan, you guys would have, central bank would have been one of the early movers in terms of deciding that it was time to increase the key policy rate. And the Bank of Jamaica would have gotten a lot of flack for that, because a lot of persons were saying, oh, that was not the right time to increase the interest rate, because it's going to then, impact borrowing, and it's going to impact investment, and the economy is going to slow down. And so, but of course, it's almost like if there's some level of vindication now, because not only has the U.S. Federal Reserve and other central banks come out and started to hike interest rates as well, they've done so in recognition that these low interest rates need to rise if it is that we want to tame this inflation monster. So I wanted to tie in the whole notion of interest rates in there. So when you see central banks coming out and say, hey, now it's time that we increase the interest rates, it's really predicated around, like Keenan would have mentioned, in terms of ensuring that the central bank is able to manage inflation in the way that they would want. Yeah, and so that's a key point there. How do you feel about that, Keenan? How did you feel initially when there was so much pushback against increasing the inflation, the interest rates to tame inflation?
Working for the central bank, you want to explain to the public at least that this is a trade-off that we have to deal with. In economics, we have to deal with trade-offs. So inflation itself, especially for persons whose assets are mostly cash-based, persons who are in lower socioeconomic demographic, then they are at risk of inflation being, it is the greatest evil for them in terms of their spending power and purchasing power. So the central bank had to be aggressive and, as you said, one of the early movers to try and stave off these inflation expectations. So to combat inflation, we've raised interest rates from 0.5% to 5%. And, I want...
And that's a big jump. Even some well-known Caribbean economists were saying, that was aggressive. When you guys came up with those initial jumps, we were saying that's aggressive, boy. Continue. Sorry.
It's huge. But we, unless you own a lot of assets that are not cash-based, which are typically persons in the higher demographic, socioeconomic demographic, they benefit from inflation, but the majority of the population won't, and the monetary authority has to kind of move swiftly. So we've had several basis point increases in the last couple months. And I wanted to go back into the economics behind everything. So central banks are employing now what's called a contractionary monetary policy. So as you said, in the decade before this, interest rates were low. That was accommodative monetary policy because we wanted to expand the economy. And now, since it's contractionary, by raising interest rates, we are now incentivizing saving, which is to take money out of the system rather than to borrow. So, your mortgages, your car loans, all of those things, we expect those to go down. But when we raise the interest rates on the policy side, it's also called a signal rate. So the signal is supposed to send, as the name implies, it sends a signal to the rest of the economy, especially commercial banks. So if the central bank raises it, it's a price floor. We expect that the commercial banks will follow suit, depending on the strength of the monetary transmission mechanism. But not all central banks will do it, or they don't necessarily have to do it by the same rate. So you see a few of the central banks in Jamaica, for example, now are just starting to respond to the, commercial banks are starting to respond to the central banks raising the interest rate. They delayed it for however long they could,
Because they were making in money. Let's be honest. So much that there were concerns about a potential housing bubble in Jamaica as well. So we know that the commercial banks, their lending was up and so on. So as we say, things nice. So in their mind, it was not the right time. But again, their mandate is significantly different from that of the monetary authority, which is really to protect not just the economy, but also those at the more vulnerable in the economy, which people like me, who does keep a lot of liquid cash with the little bit that you have, even at the lower end of the economic spectrum, you see me? Those are the ones that, sometimes need the most protection. So that was interesting to me. And even with that, those interest rate hikes, persons are still up in arms about them now, as to how we go forward. So that's the interest rate. I also wanted to go ahead, Derek.
I was gonna say, you guys, we were talking about these mechanisms that I guess are put in place to control inflation. But is there like a normal accepted range of inflation in terms of what is just without these mechanisms being in place, they're just something that inflation would normally increase by a particular point over the particular period, and is there like an acceptable range? That's what I'm trying to like get at.
Yeah, that's a great question, Jared. Can I let you answer it? And in your answer, I also wanted to incorporate the element of what we refer to as good inflation, quote unquote good inflation.
Well, that's really a consideration. Like in Jamaica, for example, why we set an inflation target of 4 to 6%. So it could be different in other jurisdictions, but the idea is that you can't have it too low, because when it's too low, that's an indicator of insufficient demand in the economy, and then everything just goes into recession. And then if it's too high, as it is now, then we raise interest rates, and we are worrying about a recessionary impact anyway. So there has to be some in between, preferably single digits that are not in the range of 1 to 2%, which is showing insufficient demand, and not closer to double digits like 10, 11%. There's no real nominal figure. It depends on the dynamics of the economy and actual level of demand and output and GDP, productivity, and so on. So there just has to be some balance that factors in all of those considerations. But to go back to the point on interest rates, so when we say that the monetary authority is trying to mop up excess liquidity, so because there is an increase in the supply of money in circulation, now persons are spending money again, now that the economies have opened up and the economy is starting to heat up again. And so the aim really by increasing interest rates is to take some of that money out of the system, reduce that liquidity, mop up all of that liquidity, to have fewer dollars chasing the goods that are in existence. Because of the supply constraints, we don't have that many goods being produced. So we want to control what we can, which is on the dollar side. So it slows down the rate of price increases, which is disinflation, as opposed to deflation. So if the inflation rate was 10%, we want to lower it down to 5% or whatever it is. But we don't want deflation, because that is now going to show that there's insufficient demand, where prices actually start decreasing, right? It's just that now there's a slower rate of increase of prices in the future. So central banks, they're also going to use those interest rates, as I said, to incentivize saving. And so persons are taking on fewer loans, and that is what is heightening current recessionary fears.
Yeah. Right, Derek.
And Delano. Yeah, something that came to my mind as just as Keenan was mentioning, the word recession. And so, I mean, normally when we hear recession, I think for a normal person like me, like recession is this doom and gloom word. Once you hear it, it's like, okay, something bad is in the offing. And obviously, I think we think back to the 2008 recession. And so, is there tied to inflation? Is there anything that we're currently seeing with the current rising inflation that we're seeing now that can relate back to an impact that we saw in 2008 with the level of inflation that we're seeing now? Is there anything that can say, okay, well, we can see that kind of recession again?
Well, that's a brilliant question, to be honest, Jarek, and that's what a lot of economic debate happening now, because some economists are projecting or predicting a recession. I don't think it will be of the scale that we've seen recently in terms of the COVID-19 pandemic, and I don't think obviously it would be at the scale of the global financial crisis either. But what I think is important is one, that there's no fears also about stagflation. Which of course is really a period where you have higher prices, as we're seeing now in terms of inflation, but unemployment is also increasing as well, and you're not seeing any sort of economic growth that you would want. So that's problematic, because usually when you have higher prices prevailing, we usually see an increase in terms of employment and a reduction in unemployment. So it becomes concerning when we have high inflation or relatively high inflation at the same time that we're not seeing reductions or maintenance of unemployment rates that we would like. So then we start to talk about things like stagflation and so on. So it is a very real concern going forward now, particularly as central banks, the Federal Reserve, Bank of Jamaica and so on, or other central banks globally are increasing interest rates. And of course, Keenan would have mentioned that's really to mop up excess liquidity, but it also has the impact of reducing investment and some spending, of course, and that, of course, is going to reduce consumption in some ways. I mean, when you add that to what's going on in terms of the supply chain disruptions, the increase in fuel prices, the war in Ukraine, and so on, there's a lot happening. So I think there are very real concerns there. I don't know if Kino wants to add his perspective there.
My prediction, at least, is that current inflationary pressures are going to continue for the rest of the year. I don't think that the recession that is being predicted will be on the magnitude of the 2008 global financial crisis. The root causes are definitely different. At that time, it was more of a demand issue, and this time it is really a supply issue. We know the challenges going on worldwide with the supply chains. So prices I expect to be elevated for the rest of the year, 6 months, and start to peter out at the beginning of next year. And I think we'll start to attain normal levels of price increases by mid-year. The recession itself will cause prices to go down. But the whole idea of shrugging off a near-term recessionary risk because of 2022 growth forecasts, we can be fooled by the fact that this current rebound, persons will be asking, but how is it that we can rebound now so seemingly quickly and then jump straight into a recession? But it's the same thing that happened 100 years ago when the pandemic that happened then, and then you had the roaring 20s, and then everything crashed. So there's but a more material slowdown is expected in 2023, not as much in this year as the current demand, persons picking up back jobs again. Of course, in the US, the current labor market strength has to do more with that demand fueled by fiscal and monetary stimulus that was deployed. You look at the fact that was also correlated with an increase in remittances in the Caribbean, in Jamaica especially, jumped significantly. And now we've recognized that from April going forward, remittances have started to peter out because it acted as what we would call an automatic stabilizer during periods of crisis. So when persons' incomes are not flowing and remittances start coming in, it helped to prop up a lot of things that are going on in the economy. And so that was deployed mostly in 2020, 2021. We're easing off now as it seems as if we're getting better. Savings levels jumped, right? But savings levels now, everybody is using up those savings that they would have acquired. And the consumers post-COVID euphoria that what we're experiencing now would start to lose.
We're outside, everybody outside, money spending things nice.
Yeah, it's starting to lose steam because of the higher prices and rates that we're experiencing now. So it's just a very temporary boom to get us back on our feet. But we're heading, I guess, I don't want to say we're heading towards the edge of the cliff, but we have to, prepare for any scenario that's possible.
Mm-hmm. So I want to zoom back in on a couple of things. They're going back. And I want to specifically talk about wages. We would have pinpointed that as part of the cause of inflation, particularly cost push inflation. Now, as you will know, Keenan and Jared, there's a lot of talk now in the region. We need to increase wages. People ain't getting paid enough. Minimum wage need to go up and so on. And I've been cautious. I mean, one of my students asked me in a class last week, and I said, everybody think it's so simple to just increase the wages and that's going to fix the problem. Yeah, but I also wanted them to realize that there are consequences in terms of, adding to inflation if we have significant wage increases. I wanted Keenan to speak to that for our listeners and viewers in terms of, is now a good time for us to be increasing wages and so on? Are people right to be demanding these higher wages at this time? And it's a debate. I know our listeners are very keen on hearing us your perspective as well.
So, in my opinion, it's really difficult to avoid an increase in wages right now as the cost of living increases and persons' previous standard of living decreases. In Jamaica now, for us, we're undergoing a public sector compensation review, and that now is at variance with our targets that we had under our own economic reform program, which was, under the imprimatur of the IMF. We had to maintain a wage to GDP of 9%. Most persons who are under the guidance of the IMF, will have something similar. But now we have to increase that to about 10, 11% in the interim. It requires some amendments to some of the laws just to facilitate it. But here's the rub. So you can have an increase in wages without having a material increase on prices only if your productivity levels and your output increases. So it's a risk that you have to take, right? If you don't want, why? Because, and here's the economics behind it. As wages increase, there's more money in the economy, so people are spending. So remember, when there's an excess of money over the goods that are in circulation, you're gonna have too many dollars chasing too few goods, and that causes prices to rise. But if you simultaneously increase your productivity and the output so that the number of goods or the amount of goods in circulation also increases, then the price increase will be mitigated. So that is really the trade-off. It's a very difficult balancing act. I know ministries of finance, I wouldn't want to be in that position where they have to think about it, but socially, the social implications of not having increased wages and money for people to spend, it's too great to contemplate. Even the IMF would have come out and said that now is not really the time to focus on balancing the books so much, because we can get back to the levels that we had prior to COVID. In Jamaica, for example, our debt targets had to be delayed by 2 years just to facilitate something like this. So we can always get back to it. But if we're thinking about people's livelihoods, then we have to do all that we can. And I don't see how we're going to avoid having to increase wages in the interim, because it's at least within our control.
That's an interesting perspective there. I know some economists will disagree, and I would say, now it's time to stay the course and hope that the prices are going to taper off. In addition to that, you also mentioned productivity. And particularly for the public service, productivity can be something that's quite difficult to measure. Because a lot of the time you're not necessarily producing, goods in a way that's easily quantifiable, easily measurable. So how do we fully incorporate that? That's another perspective that I know some economists would think about as well. Because if it requires that productivity and so on increase, sort of like as a bargaining or trying to balance the scales in terms of a wage increase, there's always that concern that perhaps things aren't going to get better in terms of productivity as well. So like I said, different perspectives. I really appreciate you for sharing that one there. So we spoke about higher wages. We spoke about the next one I want to touch on is VAT, because again, this podcast is really about our people, and we want to touch on questions and ask questions of our guests that our people want to know. So some persons have been asking Keenan, why not just reduce the VAT? That's going to help the in terms of helping with inflation. We've seen in the Bahamas just put forward their budget, and one of the things that they included in their budget, similar to what Barbados did earlier when Prime Minister Mia Mottley would have put forward her budget, is that they're reducing VAT on some items and they're reducing import duties on some items, and as well as they're looking at capping freight costs as part of the calculation of duties and so on as well. Are those measures effective, Keenan? And is it as simple as just saying, let me reduce the VAT? Because people are thinking if prices are going up and VAT is ad valorem, in that it's percentage based on, so if prices increase, then technically VAT revenue should be increasing as well. Is it that simple, Keenan?
Well, I wouldn't say it's that simple. It has been proposed, especially I can speak for Jamaica. A lot of importers, manufacturers and exporters, they would have proposed to the government that we should have a temporary, cessation of duties. The same thing when it comes down to gas prices. Can we reduce the taxes a little bit? But it's a double-edged sword, because coming off 2 years of depressed revenues, basically, now to contemplate having to decrease revenues again, as the economy opens up, is a difficult trade-off. And the approach that has been taken in the Jamaican context is to earn as much money as you can from these revenues and distribute it accordingly.
Use targeted social programs, right? And so
through targeted social interventions, and certainly with the gas prices and electricity prices, that's what the government has been doing. And there are always issues of targeting are the persons who need it the most actually getting it the most. And I suppose there's no real perfect solution. They're balancing the interests of the wider macroeconomy as opposed to individuals' livelihoods and the micro economy. But in my view, I think that it's difficult to forego revenues right now, and the easier solution would be to distribute the revenue according to wherever it's needed. But that's also predicated on can we find the persons who need it the most. So it has to be as efficiently done as possible.
It's so interesting because one of my favorite sayings lately, and Professor Sir Hilary Beckles would have said this to me back years ago when I was guild president. We were agitated for something it was we were asking for, and Prof looked at me and he said, "Listen," he said, "Guild president, it takes money to care." And that has stuck with me ever since. And every time I use it quite often now. It takes money. It literally takes money to care. So if we want, these sort of social programs and these transfers and so on to be targeted, the government has to have the financial resources to do so. And so I always get back there when I hear people say, just reduce the taxes and so on, because, like you said, it's not simple and it's not easy.
Right. So we were talking about, revenues increasing at this time, and is it really okay is it ideal rather to actually have decreases in taxes, rates, and duties, and decreasing revenue to the government? And the approach taken is to actually have targeted intervention with the increased revenue so that we can distribute it in an efficient way. And recently, but there's another dimension to all of this in terms of increased spending now. That also presents an inflationary risk.
Mm-hmm.
In Jamaica, the leader of the opposition suggested that we should probably
slow down the debt payments and do the thing. Mm-hmm. Go ahead, sorry.
Accelerate our debt repayments, because debt, the servicing of debt is expected to go up, of course, with the increase in interest rates. So that is another dimension that has to be considered, the trade-off between the present and the future. As I said, in terms of our debt targets, they were delayed by 2 years in terms of attaining a specific debt to GDP target. And we know the cost of debt, how it is in the long term, what it means for sustainability. So those are things that definitely need to be considered by the policymakers, and I don't envy the persons who are at the higher levels of the decision making at this time.
Mm-hmm. I could fully agree with you there, because, like I said, it takes money to care. And if the government don't have money, they can't care. But at the same time, if you're talking about controlling inflation, you what you don't necessarily want is to be, putting too much money in the economy at the same time, even though you're trying to be as targeted as you can. And so, like you said, I don't envy those persons who are in those those decision making roles. But I have a question for you though, Jadrick, as it relates to the whole notion of inflation and rising costs and interest rates increasing, inflation and the like. As part of a lot of mortgages, there are what we refer to as the variable rate, not just mortgages but loans in general, in terms of the variable interest rate clause. Now, from my experience, although it is written in many mortgages, many loans, and so on, I've never actually heard of a case in the region, for example, or to my knowledge, where the bank has come out and told somebody, listen, your mortgage, when you contracted, when we finished this agreement, it was 4 or 5%, and based on what's happening now with inflation, of course, it's really reducing real incomes and so on, even that of the bank as well, and financial institutions. We're now going to take the decision that we're going to increase your interest rate because we do have the right to do so based on the agreement that you would have signed. Is there any concern about that? I mean, what's been your experience? I know you do a lot of corporate law.
Right. From my experience, I've probably come across one case where that has happened, and that was, I don't think there was anything in the markets or in the economy that was happening at that time that really necessitated that. I think that was just on a case by case, a specific thing that related to that mortgagor and that mortgage loan. But in terms of as a reaction to what's happening in the market, like you say, it can happen, but it's just that I've never actually seen that happen. I've never experienced that. But there is a mechanism in place for it to happen, and that's why it's incorporated into the loan, so that if it needed to happen, then the institutions can take the necessary action and measures in order to ensure that that can happen. But from my experience, I've never actually come across a situation where it has.
Okay. Keenan, any thoughts on that? I know Jamaica has a much more active, financial, greater in terms of the size, in terms of the financial market. Have you ever heard or seen anything that, or is there any research going into that, anything like that on your end?
Well, I mean, during the 2 years of depressed activity, banks would have given various moratoriums on mortgages and other loans and so on. But the sentiment in the financial industry is that it can't really, continue. And then I think there might be a greater risk of default if mortgages are not able to withstand these increases in rates, because several financial institutions have indicated that they are going to increase rates, and we know that most of the loans are variable rate. And so, it's unfortunate, but I hope that it can be staved off in some way. But that seems to be the direction, that based on communications with the financial sector and the financial entities, that we really are in a tough situation and we just don't have much of a choice.
Yeah. So, that could potentially be one of those self-fulfilling prophecies as well, in some respects, because if you're afraid about default, and you're afraid about your return, and you're afraid about the erosion of real incomes, and you as a financial institution, a financial intermediary, want to increase your interest rate based on the variable rate clause, then you're actually making it more difficult for the persons to pay, right, and to be able to satisfy their obligations. So it could actually then result in them increase the probability of them actually defaulting. So that's another interesting element there as well, because if I'm worried about you paying and I increase the interest rate on your facility, then I might be setting you up to fail. I think, so I just thought I would ask that.
But I think what we're seeing as well is like Kim was saying, post moratorium, that period, I think we're seeing a bit of an uptick in institutions calling their loans, or at least trying to put things in place. Make a demand and so forth, just to get things in place that persons could actually start, I guess, taking repayment seriously again and get the ball rolling in terms of getting back what they've lent out. Because I think the moratorium put persons in a place of kind of lax, really. So I think now we're seeing an uptick of loans being called in, and even mortgage properties being put up for auction or private treaty sales.
Yeah, I mean, and it's interesting because I'm doing some research currently on non-performing loans in the Eastern Caribbean, and one of the things that we realized is that during the period of COVID-19, a lot of non-performing loans actually went down because a lot of banks took the opportunity to restructure in ways that they perhaps could not have restructured before they started blanket moratorium and so on. And so a lot of banks took the opportunity to start to set their books right. So some loans that were sort of teetering and going into non-performing loan. And fellas say, here we're going on, now is the right time. We had the COVID-19 going on, let's just refinance and reorganize a lot of these loans. So we've actually seen the opposite, where instead of non-performing loans increasing during this period, a lot of banks have actually seen a reduction in their non-performing loans. But the question then remains, how do you go forward, how do you treat with that? Because it's going to be fine when there's a moratorium, but when payments become due again, how are people going to treat with that going forward? And of course, people might be wondering how this ties into inflation, but inflation reduces people's real incomes, which makes it more difficult for them to live, makes it more difficult for them to service their debt obligations and so on. So everything is tied in terms of how we go. Fellas, we're out of time, I mean, I think we've touched on most of what we wanted to touch on. I don't know if Jarek has any other questions, but I wanted to ask Keenan, you had any other questions, Jarek, if I ask Keenan the final question?
No, go ahead.
Yeah, I just wanted to ask, because the only other question I had was about fiscal space, and I think we've covered that a lot of our governments in the region do not have the fiscal space to increase public sector wages, reduce taxes, duties, and so on and so forth. I think we've pretty much covered that. So I wanted to ask Keenan, how do we move forward? How do we navigate 2022? I know you've alluded to some of your predictions and what you think is how we should move. But I want to ask you as a final question, how do we move forward in 2022 in terms of the Caribbean and treating with inflation and fears of recession, and as the pandemic recedes?
So I think that it would be premature to remove the sort of social protection measures that we had in place during the pandemic. So my best bet is really to continue those in terms of the targeted support. And most of my research actually goes into social protection and public financial management. And the Caribbean broadly has very good systems of social welfare. In Jamaica, we had the CARE program that was more than $10 billion would have been dispersed in the first year and the second year as well. And even as I said, there's also an inflationary pressure because of that. If you are spending and fiscal deficits are increasing, where the government spends more and it earns. But I don't think the regions' governments are going to be profligate in that sense. They will just have to ensure that whatever spending happens is targeted, because inflation, it's not, we can't avoid it. But if we are following the same path that the IMF president has recommended, right now is not really the time to focus extensively on balancing the books. We're not saying that we should throw the entire national fiscal accounts out of kilter or out of whack, but just consider that it would be really a retrograde step to remove it, just because it seems that we are now at the end of the first tunnel given the pandemic, but we should continue to increase and augment the social protection measures where we can.
Right. Thank you for that, and I agree. I think it's it's an interesting period of time, because as we navigate, we're trying to open our economies, we're trying to get things flowing again, but then we have to also manage and monitor inflation, and I think it's also difficult for particularly some of our economies here, Barbados and so with fixed exchange rates, and of course, Keenan, you would know that the monetary options in terms of monetary policy and so is not available to us in the same way as it's available to a country like Jamaica. And Jarek, if you remember from when we were taught in, because Jarek and I did economics in A-level college back in the day, Cambridge at A-level. If you remember from them times, Jarek, I know it's over, well, that was 10, 15 years. Yeah, if you remember, the difference in terms of the tools available to a monetary authority with fixed exchange rate is significantly different from those with a floating exchange rate like Jamaica. So, for example, they have a key policy rate and so on that they're able to use and so on, that our central banks, and so there are different things, different tools that they have available that we don't. Right. So it becomes more difficult for us to manage the inflation monster in some ways, and in other ways it does help to have a stable currency as well. So it's two sides of the coin, but of course that's a discussion for another day. So before, as a right now, we're going to go into the final segment of the pod, Keenan. I don't know if you've listened to our podcast before, but in the end, we usually raise our glass or our beer bottles, whatever we're drinking, to some new development, whether it be personal, whether it be regional, whether it be international. So as the guest, you get to go first. What are you raising your glass to this week? What are you drinking to? What can you raise a toast to this week, Keenan?
What am I drinking a toast to this week? Well, I guess more something along the lines of professional development. I would have had an opportunity to now work with the persons in central government determining fiscal policy by, I guess, the end of this month. So I won't be with the central bank for much longer.
Wow. And big moves, boy. Up and up and up.
That's something worth celebrating.
Yeah, congratulations, and we wish you all the best. I certainly will be following. I've been keen in terms of your musings and so on Twitter, and your reputation continues to grow, and we're glad that you took the time to be on the podcast with us, so we could definitely raise our glasses to that.
Definitely raise our glasses.
Cheers and congratulations, all the best. Yeah. Jarek, what are you drinking to this week, bro?
My why drinking to always kind of revolves around a few topics, but this week I want to go back to something that we missed just because we weren't recording at the time, and was back to Easter and Crifter Games. I just want to go back to that because, former athlete, I like to say, Simmons, and just we had a good tally haul, a good haul of medals, I should say. We had a decent tally. I think we had like 13 athletes representing Simmons, and we were able to do something there. We got more bronze and silver, I think, than any other occasion. So I just want to raise my drink to that, to our athletes, to continue development of sport in the nation and around the region. Yeah.
You can raise our glasses to that.
And what about you?
I want to raise my glass Yeah, man, I always might bet the governments, the heads of state, the heads of government for some of our CARICOM countries who went to the Summit of the Americas in the US that just concluded in Los Angeles. And they went there and I was really heartened to see them criticize in their actual presence, the president, the vice president, and so on. I was happy for them to voice their opinion on the exclusion of Cuba, Venezuela, Nicaragua, and so on. As you know, Jarek, our prime minister would have not attended. He would have boycotted the summit. Yeah. But those who went, Prime Minister Motley, John Brezino from Belize, and so on, they would have made their feelings known about how we in the Caribbean generally, I can't speak for everybody, but how we in the Caribbean generally feel about Cuba's exclusion and the continued blockade against Cuba and so on, and the treatment of Venezuela and so on. So I was really proud to see that, to know that we're not just going there and sort of, towing the line or sort of, coloring to speak about the issues that affect us. And I was pleased to see that. So I want to raise my bear, in this case my Harun bear, to those leaders who took a stand for the inclusion of Cuba and Venezuela in terms of our regional discussions. And so
could definitely raise our bottles, our glass to that. So everyone, this has been another episode of A Lawyer and a Policy Analyst Walk Into a Bar. I want to thank our guest again, Mr. Keenan Falconer, for joining us. It's been a great education this episode, for me especially, listening to these two economists just hash it out, discuss the way forward to the Caribbean and what we are likely to expect during this period. Guys, again, we're on a new platform now. Don't forget to like, subscribe, follow on YouTube, follow our podcast wherever you can listen to it. And as always, until next time, I'm the lawyer, Jadwick Cummings.
And I'm Delano D'Souza, the policy analyst. Catch you next time.